Well, g'day there traders and friends, market enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down and bring you a weekend market update. I will say from the outset of this market update, I am going to be referencing Pro and what I've just gone through in the 1 hour and 20-minute class, which is up on the website. What I did, I really tried to position myself in terms of what the students and class participants want to hear in terms of setting up their accounts for what is ultimately going to be that final rally higher until we start to turn and roll and ultimately break below some of these major levels which we've most recently at least established throughout the month of January. Obviously, we've based ourselves here. We really plateaued down here, at least made a bottom about 15.4 on the Dow Jones Industrial Average. And if you go back to that video I put out a week ago, we've been expecting the bullish bounce. The title was called Shorts Beware. And since that video update, the Dow Jones Industrial Average has rallied just over 1,000 points from those swing lows. So, I mean, this bullish move which we saw, especially on Friday, with the Dow Jones Industrial Average being up very close to 400 points, it hasn't come as a surprise to anyone. It's what we've expected. In fact, a lot of people in that class have actually taken out short-term core positions on the DIAs or on the Qs or on the SPYs, and they're taking advantage of these little correctional type of movements back into varying areas of resistance. Not only did we position ourselves very nice throughout the months of November and December for the sell-off which happened in January, we're also playing the upside and then ultimately going to flip those positions and start taking on, again, the primary trend direction, which is down at the moment, given, of course, that on the Dow, we've made an all-time high through to May 2015, and since then we've been establishing these lower highs, consecutive lower highs. The writing, so to speak, is on the wall right now. If you can understand this, or at least you're well-versed, in technical analysis, it's very easy to illustrate and to point out where this market is moving to. For those without the untrained eye, you can always ask for help, and I encourage you to move into that pro analysis class and to see this analysis for itself. What I did over the weekend is that, again, I positioned myself in terms of answering questions as to what the students want to hear, or how at least to position their accounts, what levels to look at, and what types of trades to open up, given, of course, that the market pushes back on up into certain areas until we start to see at least the market break these long-term macro support levels. If I zoom out to the weekly chart right now, you can see that the Dow Jones, for instance, has really made quite a strong base for a number of years right now. Since 2014, every time we've come back down to really 16,000, just below it, you can see these long lower wicks over here. The market has bounced. The big differentiation between where we are now, or the distinction from where we are now to where we were at late 2014 and even earlier, at least mid into 2015, is that the trend itself has changed. And if you just acknowledge that the trend itself, the primary trend, which has been bullish since March or May 2009, all the way through to 2015 until we saw the first lower low establish itself on the Dow and the S&P, well, then you're a step or two ahead of the majority. A lot of people still are looking at these markets as a buying opportunity, a buy the dip opportunity. But not only have we seen the first lower low, we've also established the first lower high. On top of that, if you look outside of the Dow Jones Industrial Average, the S&P actually established its second lower low. So if you pay attention to the August lows over here, and you look at the low which we've just established in January, it is the second lower low. This is really the first two lower lows since the year 2008 or 2007, 2008 top, before we really moved into that 2009, or at least through into 2009, that really big sell-off in terms of a technical bear market. We're at that point right now. We are expecting a bounce, and we have been expecting a bounce on the markets, but if you just understand what to do and where to position yourself with leverage or without leverage, it's up to you depending on your risk tolerance, then you can really make good of what is potentially going to be a very bad 2016. The writing, once again, is on the wall, and I'm breaking it down in as much clarity as I possibly can. Actually, this week I went through in full transparency and I said, look, these are the levels where I am opening up positions and this is what I'm looking for, and only upon this contingent will I start opening up additional put contracts, which I'm already holding on this market, and since November and December, which is hugely profitable and hugely profitable for a lot of people. These little correctional moves are not to be bought in just to really surmise what I went through over the weekend. These correctional moves are not to be bought. Instead, you want to trade in the direction of the trend. And the trend, whether you want to acknowledge that right now or not, is that simply it has changed. It has changed. Do not resist change. Accept change. Change happens. It's cyclical. We're seeing a bullish rally back up into overhead resistance. When this phase, at least, this cyclical bullish sort of sentiment sort of ends its course or runs its course, it exhausts. suppliers just simply going to flood this market up at these higher levels. People are really going to be selling their positions which they've accumulated maybe for the past 3, 4, 5 months. Could have even been dated back to 2015, but they're going to become a little bit hesitant on at least the strength of the market breaking out to all-time highs. At that point in time, the dynamic shifts. We hit a tipping point, and what follows that soon after is very strong selling pressure, ultimately capitulation when we break these levels. That capitulation right now, and I'm going to share this on YouTube, is going to come on in here on the Dow Jones just below or just above 15,500. Once we get a true breakdown below the August lows and the January 2016 lows, that's where you see markets fall like a rock. Now, I'm not suggesting that that's going to happen over the next 1 month. It probably won't even happen for the next 2 months. But right now, we're going through the phases of a trend transition. And if you can pick up on those phases, if you understand the sentiment and how it shifts, how it moves, and you can work with it, you can really make good of potentially, again, a really bad scenario playing out in 2016. So again, just a quick analysis moving forward. We're expecting the market to again continue its bullish move, its net positive momentum to the upside. However, we're expecting it to be short-lived, and I've gone through in that analysis video in Pro the levels which I'm watching and what I'll be doing at certain levels when we hit certain price targets. And at that point, or at this point in time, we're in a very, very peculiar type of situation. We're in a we're in a flux right now, and it can go really one of two ways, and really the markets fall from here, or they move on up a little bit higher and we get offered a better percentage to actually reshort the market. And that's really where we're moving to in scenario 2 right now. So I just wanted to update you with that. Have a look at Pro if it's of any interest. I'm sure it will be beneficial to you. Outside of that, friends and traders right around the world, when the markets give us a really major signal like it did over here, and again, I put the video out as soon as the market gave us that particular candlestick to say, look, the short selling has probably run its course at this point, and that's exactly what's happened. I will bring you an update, but until then, if you want market updates, you need to join that analysis class and just listen through the analysis, because there's all too much that I just simply cannot say in a 20-minute YouTube video or a 10-minute YouTube update. It's just reserved for these longer 90, 80-minute presentations, which I do each and every Saturday for people in that analysis class. It is forward-looking as well. This is all retrospective, or looking back through hindsight of what the market has done. Generally, we speak about market or some of the trades which we have placed. We are in a few trades at the moment. They are bullish, short-term bullish trades, because we are expecting the market to bounce. But as soon as the trend and the intermediate trend work in, or they come back into sync, and the primary trend continues, or at least resumes its current trend, there's a very good chance at least that you will not have another opportunity to get out, or at least to short at these higher prices. This very much so is a premium. The market's giving us one final gift at the moment until it sort of gives us the kiss of death in terms of a technical picture. We're very close to hitting these levels, and now's the time at least to, if you want to learn before it happens, now's the time. Otherwise, you'll simply become a statistic in a couple of months when everything turns quite sour. So, you have the opportunity anyway. I just wanted to lay it out there for you. Outside of that, friends and traders, have a fantastic weekend. I'll be back with you with another market update when in fact the market needs it, or when the market is telling us some very important information, but at least remain short-term bullish on the market. But long-term, we are dealing with a bear market which probably started, or did start in or mid throughout 2015, and it's really going to get rolling or continue its momentum further into 2016. All the best, everyone. Have a fantastic weekend. It is James signing off on behalf of Pivot Point Trading. Goodbye.